Welcome back to the deep dive. Today we are putting on our instructor hats and diving straight into the critical details you need to master Chapter 5 of the NISM Series 12 curriculum.
We're talking the anatomy of mutual funds.
Exactly. And this isn't just a basic overview. This is the rigorous conceptual and regulatory breakdown you absolutely need for exam success.
Yeah, our mission today is comprehensive understanding. We want you to move beyond just, simple definitions.
Right. We need you to truly grasp the structure, the precise mathematics, and maybe most crucially, the mandatory allocation thresholds that the regulator sets.
And we really need to emphasize that last point. For this certification, those numerical rules, they're just non-negotiable. We're here to connect the dots and explain why these rules matter. Mutual funds can seem simple, like they're just vehicles for pooling capital, but the underlying fiduciary structure, the complex valuation mechanics, and the strict SEBI mandates. That's our focus.
Okay, so let's begin with the fundamental question. What market failure, or I guess what need do mutual funds have?
Right. Why do they even exist?
Okay, let's unpack this. The sources clearly outline 7 pretty significant burdens or responsibilities that fall squarely on an individual who's trying to do direct investment.
So just buying stocks or bonds themselves.
Exactly. And these burdens are really what push investors toward professional management.
Think about the immense effort involved. You start with the burden of selection.
Just choosing the right stock or the right bond or asset from the thousands that are available.
It's overwhelming. Then there's the burden of price. Are you paying a fair rate?
And then timing. You have to figure out when to get into the market, or maybe even more difficult, when to get out of a position.
Crucially, you face the burden of waiting, which is really portfolio creation.
Right. Simply picking assets isn't enough. You have to decide the optimal proportion for each asset to balance your risk and your return.
And that requires constant vigilance, which leads to the next burden, evaluation. You're continually assessing the asset's performance and its future potential.
And finally, you have 2 big operational burdens. The burden of exit, which means ensuring you have the liquidity so you can actually sell when you need to.
And the 7th burden, operations, is perhaps the most tedious of all.
Oh, definitely. Maintaining trading and depository accounts, handling all the legal paperwork, the tax implications, the compliance for every single transaction.
It's a full-time job.
And that, in a nutshell, is the value proposition of a mutual fund. The mutual fund is defined as the common pool of funds contributed by investors, which is then managed professionally by an AMC for a fee.
And that fund structure, it takes on all 7 of those responsibilities for the unit holders.
So let's look at the basic features. When an investment firm starts a mutual fund, they offer specific products, we call them schemes or plans, that clearly state their investment objectives.
Right, whether it's capital appreciation or income generation or just preservation of capital.
And when you invest, you are allotted units, which represent your proportional share of ownership in the assets of that specific scheme.
It's important to stress that the investor, the unit holder, never transacts in the underlying securities themselves.
No.
The pooled money is managed by the fund manager, strictly according to those stated objectives.
Yeah.
But there are 2 critical regulatory points here that you have to master for the exam.
Okay, what are they?
First, the inherent regulatory disclosure. Risk is borne directly and solely by the unit holders. There are no assurances, no guarantees, no safety nets from the AMC or the regulator about returns.
That's a big one. And the second?
A very specific rule in the Indian context. Mutual funds in India are not permitted to borrow money for the purpose of investing.
So no leverage.
None. Any leverage to enhance returns is strictly prohibited. The unit holders are the sole owners of the assets.
That is a fundamental constraint on the fund manager's activities. So how do we distinguish one mutual fund product from another? The source material identifies 4 key differentiating features.
The first, and I think the most defining feature, is asset allocation.
The mix of assets, equity, debt, money market instruments, commodities, or, a blend of those.
The second is the investment objective. Is the goal long-term growth or immediate income, or maybe a combination of the 2?
Third, we have to look at costs and fees. This includes the annual total expense ratio, or TER, which covers management and operational costs.
And any charges that might be applied when you're entering or leaving the scheme, which are called loads.
And finally, the operational details, the specific terms and conditions governing how you subscribe to the units, how you redeem them, the cutoff times, all those ongoing transactional rules.
Exactly. By examining those 4 features, you can really evaluate if any given scheme is suitable for an investor.
Now we're shifting gears completely. We're going into Section 1, which covers the structural foundation, the core terminology, and importantly, the mathematical cornerstones.
Let's start with the structure itself.
It's legally mandated as a trust. The money from investors, along with all the investments it buys, shares, bonds, property, are all held in this trust.
Which means the investors are therefore the joint beneficial owners of the trust's assets. This is why it's not direct ownership. It's indirect proportional ownership.
And that pooling structure immediately leads to the concept of proportionate representation.
Right. Profits, losses, and costs must always be shared in strict proportion to the investment made.
Let's walk through the specific example from your source material, because this is the clearest way to understand that fairness mechanism.
Okay. Imagine 3 investors. They contribute Rs 10,000, Rs 20,000, and Rs 30,000.
So a total pooled sum of Rs 60,000.
And their ownership stake ratio is fixed at 1 to 2 to 3. Now, if the fund manager invests this Rs 60,000 and the portfolio appreciates, the gain has to respect that ratio.
So if the total portfolio value rises from Rs 60,000 up to, say, Rs 72,000, the fund has made a Rs 12,000 gain.
That Rs 12,000 gain is distributed according to that 1.2.3 ratio. So the first investor stake is now worth Rs 12,000, the second's is Rs 24,000, and the third's is Rs 36,000.
Perfectly proportional.
Always. And this ownership stake is represented by the fund's units. The investors are thus called unit holders.
Each unit is typically assigned a face value, which is usually Rs 10, and that's mainly for accounting purposes.
So in our example, if that initial Rs 60,000 was collected at a Rs 10 face value, the fund has issued 6,000 units in total. The unit capital is Rs 60,000.
But the real measure of performance moves far beyond that fixed face value. This requires something called mark-to-market, or MTM, valuation.
And MTM is this crucial mandatory process of valuing all the securities in the portfolio at their current prevailing market price.
And this has to be calculated daily.
Every single business day. It's what ensures the fund's valuation reflects current reality, not historical cost.
And MTM leads us directly to the single most important concept in mutual funds, the net asset value, or NAV.
This is the current true value of a single mutual fund unit. The formula is absolutely foundational for the exam.
It's the current MTM value of the portfolio, plus any income earned, minus costs and expenses, all of that divided by the number of outstanding units.
Let's nail this formula down with the source material's specific calculation. We had an MTM value of Rs 72,000 in our previous example.
Okay, and let's say the fund now earns dividend income of Rs 3,000, but it also incurs costs and operational expenses of Rs 600.
So the net assets are 72,000 from the MTM, plus Rs 3,000 in income, minus Rs 600 in expenses.
That totals Rs 74,400 in net assets.
Right. And since we established there are 6,000 outstanding units, we divide Rs 74,400 by 6,000.
Which gives us the final NAV of Rs 12.40 per unit.
A pretty significant increase from that Rs 10 face value.
And the exam requires you to know that this NAV calculation must be performed and declared every single business day. This constant valuation is absolutely central to fairness.
And fairness is paramount, which leads us to the parity principle. All transactions, new subscriptions, or redemptions, they have to be priced using the current NAV.
Why?
Well, if they weren't, the action of an investor entering or exiting would unfairly dilute or accrete the value for the existing, continuing investors.
This is where the exam loves to test your conceptual understanding, often using the 4 scenarios that are in the source text.
Okay, let's walk through them slowly. We'll keep that initial NAV of Rs 12.4 as our baseline. That came from Rs 74,400 in net assets and 6,000 units.
Got it. Scenario A, subscription at face value. A new investor buys 1,000 units but pays only the Rs 10 face value, so they pay Rs 10,000.
Okay, so the total assets become Rs 84,400. That's the original 74,400 plus the new 10,000, and total units are now 7,000.
So the resulting new NAV is Rs 84,400 divided by 7,000 units, which equals Rs 12.05.
So the original investor's NAV is going to dilute it. It dropped from Rs 12.40 down to Rs 12.05 just because the new investor paid less than the units were actually worth.
That's completely unfair.
It's
unacceptable.
Totally. So scenario B is subscription at current NAV. The new investor buys 1,000 units but pays the correct price of Rs 12.40 per unit. So they pay Rs 12,400.
Total assets now become Rs 86,800. Total units are still 7,000.
And the new NAV is Rs 86,800 divided by 7,000 units, which remains exactly Rs 12.4.
No dilution. The transaction is fair to everybody.
Perfect. Now let's look at redemption. Scenario C, redemption at face value. An existing investor redeems 1,000 units, but only gets the Rs 10 face value. They get Rs 10,000.
So the net assets fall to Rs 64,400, and the remaining units are 5,000.
The new NAV is Rs 64,400 divided by 5,000 units, which results in Rs 12.88.
So the remaining investors unfairly benefit. Their NAV went up. This is accretion, and it's also unacceptable.
Right. Which brings us to the final correct way. Scenario D, redemption at current NAV. The investor redeems 1,000 units and receives the current NAV of Rs 12.4 euro. They get Rs 12,400.
Net assets fall to Rs 62,000. Remaining units are 5,000.
And the new NAV is Rs 62,000 divided by 5,000 units, which once again remains perfectly at Rs 12.40.
The conclusion here is foundational. NAV remains unchanged after any transaction only if the units are priced at the current NAV. This is the bedrock of the open-ended fund structure's integrity.
Okay, let's take a quick breath. We've nailed the math. Now let's move on to the cost side. When we discussed NAV, we included costs and expenses. The main ongoing cost is the total expense ratio, TER.
The TER is expressed as a percentage of the fund's daily average net assets, and it's calculated and charged annually. This is crucial. The expenses are deducted before the NAV is declared.
Right, you don't write a separate check for it. The NAV is simply lower because of these expenses. And SEBI puts a cap on the TER to protect investors.
Beyond the TER, we have loads. We must remember the current regulatory status here. SEBI strictly prohibits entry loads.
You cannot be charged for subscribing to a fund.
But they can impose an exit load. This is a charge if an investor redeems their units before a specific holding period is complete, often 1 year.
And that load is calculated as a percentage of the NAV, and it's just taken out of the proceeds you receive. So for example, if the NAV is Rs 12 and the fund has 1% exit load for an early redemption,
the load is Rs 0.12. So the investor receives a net redemption price of Rs 11.88. This is really just to discourage very short-term trading in schemes that are designed for longer horizons. Now that we've got the math and costs down, let's move into Section 2. We're covering the operational structure, scheme classifications, and the key players who actually run the show.
We can begin with SEBI's broad organization of all schemes into 5 macro categories.
These are equity, debt, hybrid, solution-oriented, and others. This is the primary categorization system.
And SEBI enforces a very strict one scheme per category rule. This is to prevent fund houses from launching dozens of confusing or similar products.
But there are 3 distinct exceptions to that rule that you have to know. A fund house can offer multiple.
1. Index funds or ETFs, but only if they track different indices.
2. Fund-of-funds, but only if they invest in different underlying schemes.
And 3. Sectoral or thematic funds, as long as they focus on different sectors or themes.
Okay, next, let's look at the structure based on duration and tradability.
First up, open-ended funds. These are the most common structure. They have no fixed maturity date.
The fund is continuously open for subscription and redemption. You can buy or sell units directly with the fund house at NAV-linked prices on any business day.
And while they can be listed on stock exchanges, the main place for transactions is the fund itself.
Then you have closed-end funds. These operate more like a fixed-term project. Units are issued only once during the initial new fund offer, or NFO.
They have a specific fixed maturity date, say 3 years, and at that point the fund is wound up and the unit holders get their final NAV proceeds.
Now, critically, because they are closed for continuous transactions with the fund house, SEBI mandates that closed-end funds are mandatorily listed on stock exchanges.
This secondary market listing is the only way for investors to get out before maturity. And a key exam point here. The mutual fund itself is not involved in these secondary market trades between investors.
Right. And finally, there's a hybrid called interval funds.
These are initially closed-ended, but they have specified windows or transaction periods, maybe 3 days every quarter, when you can buy or sell units directly with the fund at NAV-linked prices.
And just like closed-end funds, they're also listed on exchanges for continuous liquidity outside of those specific interval periods.
Okay, let's break down the working of a mutual fund. The complex web of roles. It all begins with the AMC, the asset management company.
They're the engine. The AMC is the specialist investment manager that employs the fund managers. They're responsible for the day-to-day operations, the marketing, the distribution, and of course, portfolio performance.
They're the face that deals directly with investors.
Standing above the AMC are the trustees.
Yes, the fund's assets are held in a trust, and the trustees supervise the AMC, making sure it acts strictly in the best financial interests of the unit holders. They are the fiduciary oversight.
And the regulations are stringent here. Trustees must hold meetings at least 6 times a year to review and monitor the AMC's activities.
Then we have the external regulatory roles. First, the custodian. We can think of the custodian as like a high security vault.
That's a great analogy. The official definition is an organization that holds the securities and other assets of mutual funds and other institutional investors.
Right. They hold the physical assets or the electronic records of them, and they settle the trades that the fund managers execute. This separation between the AMC, who manages the money, and the custodian, who holds the assets, is a critical regulatory safeguard.
The fourth critical player is the R&T agent. That's the registrar and transfer agent. Their job is all about records and administration.
The R&T agent's definition is they maintain the records of investors who bought what, when, and how much. They handle all investor services. They maintain the unit holder records, process applications, issue folio numbers.
So companies like CAMS and KFinTech, they're the backbone of the industry's record keeping.
Exactly. And then you have other SEBI-registered players, banks that handle the money, the auditor who reviews the accounts, distributors, and brokers who execute the trades.
Okay, when a scheme launches through an NFO, there are 3 key documents that are mandatory.
The first is the Statement of Additional Information, or SAI. This has all the statutory, legal, and regulatory information about the AMC and the fund's structure.
Then you have the Scheme Information Document, the SID. This provides the specific, detailed investment objectives, strategies, risks for that particular scheme.
And finally, the Key Information Memorandum, or KIM. This is the essential summary document, a condensed, easy-to-read version of the SID, which prospective investors have to receive and read before they apply.
Let's just quickly wrap up this section by clarifying how returns are handled, the whole dividend versus growth options thing.
Sure. Under the standard growth option, any gains, profits, income are retained within the scheme. This causes the NAV to rise over time. The investor only realizes those gains when they eventually sell their units.
And the alternative is the IDCW, or Income Distribution Come Capital Withdrawal option.
Right, which used to be called the dividend option. SEBI mandated the name change after October 2020. Under this option, the fund declares and distributes realized profits to the unit holders.
And crucially, the NAV drops by the exact amount of that distribution.
The name change was essential because the regulator wanted to be very clear that these distributions, while they feel like income, might actually involve a withdrawal of the investor's own capital if the fund hasn't generated enough profit.
So it stops people from mistakenly thinking every distribution is pure income.
Exactly. And if an investor chooses the IDCW reinvestment option, the distribution isn't paid out in cash. It's immediately reinvested by the fund to buy more units in the same scheme for that unit holder.
Okay, now we are entering the absolute core of NISM regulatory prep. Section 3, the mandatory allocation thresholds for equity and debt schemes.
And remember, the fund's objective growth versus income is what drives its asset allocation.
Let's start with equity schemes. Their main goal is capital appreciation, so they are inherently designed for long investment horizons.
Before we get into the percentages, we have to clearly define the market capitalization buckets.
No.
These are determined by AMFI based on full market cap, and they get updated every 6 months.
These 3 fixed buckets are the regulatory playing field. You have large cap, which is the first to 100th companies by market cap.
Mid cap, which is the 101st to the 250th companies.
And small cap, which is the 251st company and onwards. These definitions are static, and fund managers have to stick to them.
Let's start with the scheme specifically designed to enforce diversification, the multi-cap fund. It has to invest a minimum of 75% of its total assets in equity and equity-related instruments.
But here's the crucial constraint, and it's designed to stop this category from being just a large cap fund in disguise. It must invest a minimum of 25% each in large cap, mid cap, and small cap stocks.
Remember that 25-25-25 split. This was a deliberate regulatory move to make sure capital flows consistently across all market segments.
Okay, now for the specialized cap funds. A large cap fund has to commit a minimum of 80% of its total assets to large cap stocks.
That's one of the highest mandatory allocation rules, which makes sense, as it's meant to focus on the top 100 companies.
The large and mid-cap fund needs a minimum of 35% investment in large-cap stocks, A&D, a minimum of 35% investment in mid-cap stocks.
Note that this adds up to a 70% minimum, which allows for some flexibility in the remaining 30% of the portfolio.
Right. And the general rule for the other cap-specific categories, the mid-cap fund or the small-cap fund, is a minimum of 65% in their respective cap category.
The reason the multi-cap fund minimum is higher at 75% is because it needs that flexibility to meet all three of those 25% minimums while staying diversified.
Then you have the flexi-cap fund, which was introduced to give fund managers more agility.
It requires a minimum of 65% in equity, but the manager has the dynamic freedom to invest across large, mid, and small-cap stocks without the fixed 25% minimums of the multi-cap fund.
It's performance-driven, not rule-driven, in its cap allocation.
Next, the focused fund. This is defined by concentration, not just allocation. It requires a minimum of 65% in equity, but the portfolio must be restricted to a maximum of 30 stocks.
And the scheme has to clearly state whether its focus is multi-cap, large-cap, mid-cap, and so on.
For sectoral thematic funds, the concentration risk is reflected in the allocation rule, a minimum of 80% in equity instruments of the specified sector or theme.
A sectoral fund, like a banking fund, is very tightly focused. A thematic fund, like an infrastructure fund, invests across a broader theme: construction, cement, metal.
Exactly. And finally, the mandatory tax savings scheme, the ELSS, or equity-linked savings scheme.
The essential definition here is an open-ended equity-linked savings scheme with a statutory lock-in of 3 years and tax benefit. It requires a minimum of 80% in equity.
And you must remember that strict 3-year lock-in from the date of investment to claim the Section 80C tax deduction benefit, which is capped at Rs 1.5 lakh annually.
We should also briefly highlight the subcategory of ESG, investing in environmental social governance.
SEBI has codified 6 specific ESG strategies that funds can adopt, including exclusion, which is avoiding certain sectors, integration, and impact investing. It's a growing area of regulatory focus.
Okay, pivoting to debt schemes, we're shifting our focus from market cap to 2 types of risk: credit risk and MTM risk.
Credit risk is pretty straightforward. It's the risk of default by the issuer, it's high for corporate bonds, and it's 0 for government securities.
The most critical concept here is MTM risk, or interest rate risk. This reflects the inverse relationship between interest rates and bond prices.
So if interest rates increase, the value of existing debt instruments falls.
And the longer the duration or tenor of the bond, the greater this price volatility or MTM risk will be.
The regulatory classification for debt funds is defined by the securities Macaulay duration. This is a weighted average time until the bond's cash flows are received. It's a much more sophisticated measure than simple maturity.
And these numerical thresholds for Macaulay duration, you just have to memorize them.
Yes, there's no way around it. Let's run through them systematically.
Okay, the shortest is the overnight fund, with a maturity of exactly 1 day.
Next, the liquid fund. It invests in debt and money market securities with maturity of up to 91 days only. These are all about high liquidity and minimal MTM risk.
Now, for the Macaulay duration bands,
Ultra short duration fund. Duration between 3 months and 6 months.
low duration fund. Duration between 6 months and 12 months.
Short duration fund.
Duration between 1 year and 3 years.
Medium duration fund.
Yeah.
Duration between 3 years and 4 years. Though the definition allows for 1 to 4 years during adverse market situations.
Right. Then medium to long duration, which is 4 to 7 years. And finally, a long duration fund has a Macaulay duration greater than 7 years.
That list of duration buckets is demanding, but understanding them is absolutely key to classifying a fund's risk profile. The longer the duration, the more sensitive the NAV will be to interest rate changes.
We also have funds defined by their credit or issuer profile. The corporate bond fund targets high-quality issuers. It must invest a minimum of 80% of its assets only in corporate bonds rated LAA plus and above. And in sharp contrast, you have the credit risk fund. This one targets riskier issuers for higher yields. It must invest a minimum of 65% of its assets only in corporate bonds rated AA and below.
Note the explicit exclusion of AA plus bonds. This fund literally defines itself by taking on higher credit risk.
The banking NPSU fund is defined by its issuer base. It requires a minimum of 80% investment in debt instruments issued by banks, public sector undertakings, public financial institutions, and municipal bonds.
These instruments generally carry very high credit quality because of their issuers' backing.
Finally, the government securities funds, or gilt funds. The definition is an open-ended debt scheme investing in government securities across maturity.
Since GSECs have 0 credit risk, the only risk is MTM risk. They require a minimum of 80% in GSECs.
And there's a very specific subset, the gilt fund with 10-year constant duration.
This also requires a minimum of 80% in GSECs. But the fund manager has to actively manage the portfolio so that the Macaulay duration stays at precisely 10 years.
which makes it a vehicle that's highly sensitive to long-term interest rate movements.
One last specific debt type, the floater fund. This scheme needs a minimum of 65% investment in floating rate instruments.
And if they invest in fixed-rate bonds, they have to convert that exposure to floating rate using derivatives, like interest rate swaps, to meet the mandate.
Right. This fund offers protection when you expect interest rates to rise.
Let's transition smoothly into Section 4, which covers hybrid, specialized, and passive vehicles. Hybrid schemes, by definition, they balance equity and debt.
And the risk profile depends directly on the size of that equity allocation.
Starting with the most risk-averse hybrid, the conservative hybrid fund.
This is predominantly debt. We're talking 75% to 90%, only 10 to 25% in equity. It's designed for income with just a little growth kicker.
Next, the balanced hybrid fund. This is designed for near equal weight, 40% to 60% in equity and 40% to 60% in debt.
And a key detail for the exam, no arbitrage is permitted within this specific scheme.
The aggressive hybrid fund is the mirror image of the conservative one. It's predominantly equity, 65% to 80%, and only 20% to 35% in debt.
And the regulations state that fund houses typically offer either the aggressive hybrid or the balanced fund, but usually not both of them.
Then we have the multi-asset allocation scheme, which promotes maximum diversification.
It mandates investment in at least 3 asset classes, with a minimum allocation of 10% each in all 3.
This is a critical point. Foreign securities are not treated as a separate asset class for the purpose of this 10% minimum rule. The 3 classes are usually equity, debt, and something like gold or commodities.
Now, moving to the specialized arbitrage fund. We need a clear conceptual understanding of arbitrage first.
The definition is simultaneous purchase and sale of an asset to take advantage of difference in prices in different markets.
Right. These funds exploit the tiny temporary price differentials between the cash or spot market and the derivatives or futures market for the same stock.
So the fund buys in the cash market and simultaneously sells the future contract. Because the position is completely hedged, the volatility is extremely low, almost like a liquid fund.
But here's the twist. For taxation purposes, SEBI requires the arbitrage fund to maintain a minimum of 65% investment in equity or equity-related instruments.
This allows the fund to be treated like an equity fund for capital gains tax, even though it has minimal market risk because of the hedging. It's a clever structure.
Now for solution-oriented schemes. These are tied to specific life goals and defined by statutory lock-in periods.
The retirement fund has a lock-in of 5 years or until the investor attains retirement age, whichever comes earlier.
Similarly, the children's fund has a lock-in of at least 5 years or until the child attains the age of majority, which is 18, whichever is earlier.
The regulatory intent here is to force the long-term discipline needed to achieve these major goals.
Okay, now for the passive vehicles, index funds and ETFs.
Both of these replicate a specific index, like the Sensex or the Nifty, rather than relying on active stock selection.
The regulatory rule is that the minimum investment in the securities of the replicated index must be 95% of the total assets.
That 5% buffer is for liquidity, cash management, and transaction costs.
Let's define exchange-traded funds, or ETFs. A security that tracks an index but has the flexibility of trading like a stock.
Right. Unlike traditional mutual funds, ETF units are listed and traded on the stock exchange all day long.
Which means the investor needs a demat account and a broker to transact in them.
We also have commodity ETFs, specifically gold ETFs and silver ETFs.
Gold ETFs usually represent physical gold. Typically 1 unit equals 1 gram, or they hold gold receipts. Importantly, these commodity funds must be managed by a dedicated fund manager who has documented experience in the commodity derivatives market.
Under the other scheme's umbrella, we find fund of funds, or FOF.
FOF doesn't invest in individual stocks or bonds. Its portfolio is made up of other mutual fund schemes. It needs a minimum investment of 95% in the underlying fund, which can be domestic or overseas.
Okay, to finalize Section 4, let's get into the specifics of closed-ended schemes.
The most common type is the Fixed Maturity Plan, or FMP. This is a closed-ended debt scheme where the manager invests in debt securities whose maturity date precisely matches the term of the FMP.
This provides very low redemption risk since the underlying bonds are just redeemed at face value on the maturity date.
However, the primary risk exposure for the investor is still credit risk, the risk that the issuer of the debt instrument defaults before maturity.
Then we have infrastructure debt funds, or IDFs. These are highly specific, closed-ended schemes targeting infrastructure financing. They have to have a tenor of at least 5 years.
And their portfolio mandate is strict. 90% of assets must be in specified debt or securitized debt of infrastructure companies.
IDFs also have a very high minimum investment threshold, reflecting their institutional focus. It's Rs 1 crore, and the minimum face value of each unit is Rs 10 lakh.
And of course, they're mandatorily listed on the exchange.
Finally, real estate mutual funds, or RAMFs. These funds invest in physical property or real estate securities.
And the regulatory requirements are complex here. At least 35% of the portfolio has to be held in physical real estate assets.
And a not less than 75% of net assets must be in physical assets and real estate securities combined.
Valuation is a massive challenge for property, so SEBI mandates that assets must be valued every 90 days by two separate valuers accredited by a credit rating agency.
And crucially, the fund has to take the lower of the two resulting valuations for its NAV calculation. This regulatory conservatism protects investors from overly optimistic real estate appraisals. Section 5 shifts our focus now to investment strategies and critical regulatory compliance processes. Let's compare active versus passive investing.
Active management is the traditional approach. The fund manager is trying to outperform a chosen benchmark index.
This requires constant, expensive, in-depth research and often results in frequent buying and selling, which means higher transaction costs. And all of that contributes to a higher TER.
The manager's actively betting against the market average.
Passive management, on the other hand, aims to generate returns that are just in line with the benchmark by simply mirroring the index's holdings.
Since there's no big research team making active stock picks, the management fees are significantly lower, and transactions only happen when the index itself rebalances.
The marginal difference between the passive fund's return and its benchmark's return is called the tracking error. A good passive fund aims for the lowest possible tracking error.
And the advantages of passive funds are pretty clear: transparency, lower costs, and built-in diversification.
SEBI has introduced key guidelines to support passive fund growth, particularly for ETFs. First, direct transactions with AMCs for ETFs.
Where units are created or redeemed directly by the fund house.
Right. Those are only facilitated for large investors, specifically those transacting above a threshold of Rs 25 crore. This pushes smaller transactions onto the exchange, which enhances liquidity there.
Second, the INAV, or indicative NAV, of an ETF has to be continuously disclosed on the exchange during trading hours. This lets investors track the real-time value of the fund's units.
Unlike traditional mutual funds, where the NAV is only calculated once at the end of the day, and also fund-of-funds investing in ETFs must use the stock exchange closing price for their own valuation.
Okay, let's move to the operational side. Processes for investing. You can invest offline through physical forms or online through websites or exchange platforms like NSE, MFSS, and BSE*MF.
Compliance here starts with PAN and KYC norms. A PAN is mandatory for all investors.
But there is a key regulatory exception. PAN is not required for individual investments, either lump sum or SIPs, that do not exceed REIs $50,000 per annum per mutual fund house.
This is to encourage financial inclusion for smaller investors.
Now, KYC, or Know Your Customer, requires collecting identity and address information, often with in-person verification or IPV.
Crucially, KYC only needs to be done once, and it's valid across the entire capital market. The exam point to hammer home is this: KYC formalities must be completed by all holders listed on the folio, including joint holders.
In eKYC, using Aadhaar data has simplified this a lot by removing the physical paperwork and the IPV requirement.
We should also touch on global regulatory pressure, specifically FTC and the CRS.
Right. Mutual funds have to do stringent due diligence to identify foreign reportable accounts and report them to Indian tax authorities. This is a part of the global crackdown on offshore tax evasion.
And if an investor's status changes, say they become a U.S. resident, they have to report this change to the mutual fund within 30 days.
Now let's talk about purchasing units during a new fund offer, or NFO.
NFOs are typically open for 15 days, except for ELSS, and payment has to be made through approved banking modes, including NFT, RTGS, and, increasingly, ASBA.
Let's define ASBA. It's application supported by blocked amount, and it's critical for IPOs and NFOs.
It's a facility where your investment application is accompanied by an authorization to your bank to block the application money in your account until the allotment is completed.
So the money stays in your account, earning interest, and only moves when the units are actually allotted. It's much safer.
And units allotted after the NFO must be finalized within 5 business days of the NFO closing date. After that, open-ended schemes conduct a continuous offer selling units at the daily NAV.
Regarding payment instruments, cash payment is capped at Rs 50,000 per mutual fund house across all its schemes.
And to prevent money laundering, payments must always come from a bank account where the first holder of the folio is also an account holder. A folio can have up to 3 joint holders.
Okay, on distributor commissions, SEBI mandates a full trail model. Commission is paid periodically for as long as the investment stays with the fund.
Upfront commission is generally prohibited, though some small upfronting of the trail commission is allowed for XII under specific conditions.
The investor, however, may be charged a transaction charge, which is paid to the distributor out of the investment amount. This is capped at Rs 150 per purchase transaction of Rs 10,000 and above.
And there are 2 crucial exceptions here. This charge only applies to investors other than first-time investors, and there is no charge at all on direct investments made without a distributor. Section 6 focuses on the systematic transactions that provide investment discipline and flexibility to the investor.
And the most famous of these is the Systematic Investment Plan, or SIP. A fixed sum is invested automatically and periodically.
The primary benefit of the SIP is the mechanism known as Rupee cost averaging.
Rupee cost averaging works because by investing a fixed amount of cash, you automatically buy more units when the market price, the NAV, is low.
And you buy fewer units when the price is high. Over time, this results in a lower average cost of purchase per unit compared to trying to time the market.
Conversely, you have the Systematic Withdrawal Plan, or SWP. This allows for periodic redemptions of a fixed amount.
This is widely used by retirees or investors who want a regular income stream or systematic profit booking.
And while the cash amount you receive is fixed, the number of units redeemed will vary depending on the prevailing NAV at the time of each withdrawal.
The third systematic plan is the Systematic Transfer Plan, or STP. This is used to periodically shift a specified sum from a source scheme, often a low-risk liquid fund,
to a destination scheme, often a higher-risk equity fund, but within the same fund house.
Functionally, the STP is a simultaneous SWP from the source fund and an SIP into the destination fund.
It's a really effective way for investors to move large lump sums into volatile equity markets slowly, benefiting from Rupee cost averaging without keeping their capital idle.
And distinct from these periodic plans are switches. A switch is a single, non-periodic transaction that combines a redemption and a purchase on one specified date.
It's used to move capital instantly between different schemes, or even just to change the option, say from growth to IDCW, within the same scheme.
Looking at redemption mechanics, open-ended funds allow redemption anytime, adjusted for any exit loads.
And to prevent fraud, SEBI mandates that redemption proceeds can only be credited to the investor's registered bank account. Funds let investors register up to 5 bank accounts for flexibility.
As proof of investment and transaction, 2 primary documents are issued. The Statement of Account, or SOA, is dispatched after every single transaction.
And then there's the Consolidated Account Statement, or CAS, which is a holistic view. It's sent monthly if there were transactions during the month.
And if not, it's sent every 6 months. The CAS is extremely useful because it aggregates all your mutual fund holdings across different fund houses under one pan.
And critically, it must disclose the gross commission paid to distributors, which ensures transparency.
Investors also have the option of holding units in DEMAT form. Units can be dematerialized and held in an electronic DEMAT account.
But this requires transacting through a stockbroker, and the investor has to bear the maintenance costs for the DEMAT account or brokerage, which adds a layer of complexity.
Finally, let's review the specific SEBI investor service standards, the timelines the AMC has to stick to. NAV, sale, and redemption prices must be declared daily.
Units have to be allotted within 5 business days of the NFO closing date.
And the most critical timeline relates to service. Redemption proceeds must be sent to the investor within 10 working days of receiving the request.
Failure to meet that crucial 10 working day deadline for dispatching dividends or redemption checks means the AMC has to pay penalty interest at a rate of 15% per annum.
That's a huge regulatory penalty.
And the expense has to be borne by the AMC itself. It can't be passed on to the scheme or the unit holders. This provides a massive incentive for the AMC to be efficient.
We are moving into the final regulatory and review section, starting with how investors should access and understand fund information.
Beyond the statutory SAI, SID, and KIM, the Fund Fact Sheet is the most utilized monthly report.
The Fund Fact Sheet is the comprehensive snapshot. It details the assets under management, or AUM, the scheme's benchmark, minimum investment amounts, exit loads.
The fund manager's name, the portfolio allocation top 10 holdings, sector split key performance ratios, and historical performance figures.
And crucially, it must feature the riskometer.
This is the pictorial risk gauge that must be on the NFO application, the SID, the KIM, and all advertisements.
And you must recognize the entire progression of risk levels from lowest to highest. Low, low to moderate, moderate, moderately high, high, and very high.
The regulator enforces this visual tool to make sure investors understand the risk they're taking before they invest.
Okay, discussing SEBI regulation, the bedrock is the SEBI mutual funds regulations from 1996.
These regulations provide comprehensive investor protection. They define mandatory promoter capital requirements, they enforce mandatory trustee and SEBI approval for all new schemes.
And they dictate strict diversification limits to mitigate single stock or single sector risk.
The regulations also strictly define the valuation and accounting norms to ensure NAV is calculated consistently and accurately. They enforce strict limits on expenses, the tier limits, and they mandate compulsory performance reporting against benchmarks.
The framework also requires sophisticated risk management frameworks. As part of this, funds must measure their potential exposure to catastrophic losses. And this is where the concept of VAR, or value at risk, becomes relevant.
We define VAR as the maximum loss over a target horizon, such that there is a low, pre-specified probability that the actual loss will be larger.
While that's technical, in the regulatory context, VAR is a key conceptual measure to make sure the AMC understands and monitors its worst-case scenario exposures.
Let's just summarize the benefits and costs for a final review. The benefits are substantial.
You have diversification, even with investments as small as Rs 500 through an SIP. You have high liquidity, especially in open-ended schemes. And you get access to world-class professional management.
You also get flexibility in how you invest and in choosing options like growth or IDCW. There's tax efficiency, since the fund structure itself is tax-exempt. And there's accessibility.
Right. Funds can invest in wholesale, unlisted, or privately placed instruments that are just inaccessible to retail investors.
However, these benefits come with the inevitable drawbacks. The costs and fees, like the TER and loads. Limited control, because you have no direct say in the fund manager's day-to-day decisions.
And indirect ownership. The investments are held in the fund's trust. You're only the beneficial owner.
Finally, a quick note on the Specialized Investment Fund, or SIF. This is a newer category for very high net worth individuals.
The minimum investment required for SIFs is substantial. Rs 10 lakhs across all investment strategies. This was a dense, but I think an absolutely necessary deep dive into the core structure and regulatory landscape of mutual funds.
Yeah. To summarize, we covered the fundamental need for pooling, the precise mechanics of NAV calculation, the crucial parity principle that ensures fairness,
the legal roles of all the key constituents, and most importantly for your certification, the non-negotiable numerical thresholds governing scheme allocations.
Mastering those numbers, the 75% total equity and 25-25 caps for multi-cap funds, the 80% requirement for large cap and banking PSU funds, the specific Macaulay duration brackets for the debt categories.
Or the minimum 10% allocation in 3 asset classes for multi-asset funds. That's essential. You have to internalize those figures.
But let's leave you with one final thought that kind of elevates this from rote learning to strategic understanding. We talked about how a fund's performance is often judged by its relative performance against a benchmark index.
Right. The fund manager's job is to either replicate or better that index.
Now connect that pursuit of performance to a regulatory requirement we mentioned earlier. SEBI has made it compulsory for mutual funds to actively vote on specified resolutions at company general meetings.
Things like corporate governance, director appointments, major mergers, always with the stated goal of acting in the interests of their unit holders.
So, since the regulator forces the fund manager, who controls massive blocks of corporate stock, to be an active participant in corporate governance by mandating voting, does this regulatory push toward stewardship ultimately give the individual unit holder, the beneficial owner, more long-term influence over the direction of corporate India than direct shareholders realize?
The control is indirect, but the power through pooling is absolute. Think about that application of financial stewardship.
It's a compelling concept of power by proxy, and a great note on which to consider the broader impact of this industry. Good luck with your exam preparation for the NISM Series 12.
And we'll catch you on the next deep dive.